Hello, everybody. Welcome back to Built for Life, Not Just Wealth. My name is Ryan Burklo.
And I'm Alex Collins.
And on today's episode, we're going to be talking about a backstop to the balance sheet. This is something Alex and I have recorded on in the past, and this is continually comes up in conversations with prospective clients and clients because it's not the norm. Like it's really kind of counterintuitive, I think, to most people when we're trying to build wealth, Alex.
It is. And then when we start talking about it from the concept of retirement income and like having an alternative, to like an alternative place to get money, people are like, oh, well, that makes so much sense, but it's not something that they're necessarily going to intuit themselves. It's a concept that they, really kind of need to be shown.
Yeah, so kind of breaking this down, let's just paint the picture. Like what a lot of people, I mean, even retirees that we sit down with, they get to retirement and they've got a little bit of cash, right? And then the rest of their money is like in their old retirement plan or an IRA, Roth IRA. It doesn't matter what type of an account, but it's a retirement account typically. And that money's invested typically. It's stocks and bonds. We consider bonds an investment, right? So it's some allocation to stocks and bonds. Typically it's less aggressive, so less to stocks. So
Well,
they're no longer like
but
90% stock.
less aggressive than they were, not necessarily like less aggressive, like not less than 50% stocks
Correct.
sometimes, but not always.
Right. Less aggressive than they were pre-retirement is what we're getting at there. And so what occurs is they're pulling money from their retirement accounts when they get to retirement. And the question is, the market's down. Well, you still need the money to live your life. So you're pulling money from an asset that's down.
Right.
And so we always bring up how liquid really is that asset? Like if you needed extra money, are you at all
I
excited about pulling money from this asset right now?
oftentimes I even just ask it from the question of like, okay, the market's down. Do we still need money? And clients are like, yeah, we still need money. Okay, cool. Where is it coming from? They're like, that's your job. And I'm like, yeah, you're right. It is my job. And are we excited about pulling money out of an asset that's down? And they look at me like I have grown a second head and they're like, no.
Yeah.
I'm like, okay, cool. So there's really like three different solutions to this. And like, what we need to make these decisions like at least somewhat proactive, right? Like either we can have like money sitting idle, or we can have guaranteed cash flow, or we can just have a really big pot of money so that we don't even care like what's going on in that moment. And people were like, all right, cool. I want option 3, but I'm not there.
Right.
And so it's like, okay, cool. So like, let's talk about the other 2 options. And today we're going to talk about option 1 of just having an alternative pool of money that we can pull from in the event of a down market.
So Alex and I, we speak into this and we call it true liquidity, meaning having an asset that is not correlated with the market. Meaning when the market's down, this asset is not down. It's kind of steady eddy in the background, consistently going up, right? It's not going to get market-based returns.
We're not trying to get market-based returns. We're intentionally wanting something that is not market-based.
So it's an account that it's steady eddy in the background. It's stable, something we can count on. So the thing of it is if it's exposed to the market, it's not truly liquid in the definition that we're using in this example. So diving into this, like think about this from the perspective of pre-retirement or retirement. We're all going to face several negative years in the market.
What?
And everyone laughs, just like Alex just did. If you're watching us on YouTube, Alex just laughed at that statement. And what's funny is retirees do the same thing. They laugh and then they kind of go, oh crap, you're right. Like it's still an issue, right? The emotional piece still comes into play. And this is where math breaks and emotions are getting in the room. Like it's hard to really get into this. So Alex and I always want to make sure we set up the balance sheet appropriately so that when the market's up, we're capturing the upside. And when the market's down, it doesn't affect our lifestyle, our cash flow. So
And
it's that buffer.
so many times when we bring up this concept, like we have drilled it into our clients' heads, like, you can't time the market, you can't time the market, you can't time the market. And then they're like, well, aren't you guys just timing the market? And Ryan, what would we say to that?
Well, we're not timing the market because we've always got this money sitting on the sideline. So we would have had your income would have been paid out prior to the year beginning.
Right. And like what we're talking about is making the decision after the event is known. So like we're looking at it going, okay, well, so did the market go down? If the answer is yes, then we're pulling it from an asset over on the side. We're not timing the market. We're just looking at it going, what happened? And let's make a decision based on what we know has already happened, as opposed to trying to predict where the market's going. That is the market timing aspect, is trying to predict. We're literally looking at what happened and saying, hey, instead of doing this, let's do this.
So kind of painting the picture here as I share my screen. So make sure you check out the YouTube channel if you're listening to us and not seeing the visual side, because I think the visual side will be key for this conversation. It's about positioning assets right outside of the market and positioning your balance sheet appropriately. And we're going to go through a very simplistic example, and then we're going to go through real life type of examples to show how this actually plays out, because the biggest, I think, question that most of our clients give us, Alex, is, okay, well, if this money's not correlated with the market, that means I'm losing opportunity for rate of return. So does this really work? Like, am I giving up too much for this? And so we're going to answer that question in our second part of the example here. But let's just break down the typical strategies that we see. And the typical strategies that we see, as the example, we've got $2 million. Okay. $2 million in a portfolio. Okay. That portfolio is variable, meaning it can go up and it can go down, stocks and bonds, that kind of fun stuff. In year one of retirement, let's just say there's a 9% market loss. So 9% of 2 million bucks is 180 grand. This person is taking $80,000 a year. We're kind of using that 4% withdrawal rate that a lot of retirees, or some interest only type of withdrawal rate. This person chose 4. So they're still taking 80 grand out, because guess what? They still have this life that they have to live and bills to pay. So they're taking 80 grand out. So $180,000 loss, $80,000 for income also taken out, which leaves their portfolio at the end of year one. They started at 2 million, is now down to 1.74. So $260,000 down from the initial $2 million. Year two, again, they're starting with 1.74. Let's just say there's an 11% market loss. So 11% of 1.74, that's $191,400 down. They've still taken their $80,000. Now, we didn't take into consideration inflation in this calculation, but let's just say they still only needed 80. Their end of year value in year number two, is now at $1.468 million.
The market has gone down 20%, but the portfolio has gone down 27 because of the withdrawals.
This is where people maybe start to freak out while they're in retirement, because they started at 2 million. And at the end of year two, they're down to less than 1.5. And they've only been taking out 80 grand a year. So this is where the true liquidity bucket comes in, where we want the variable bucket. We're not saying to go all out of the market. That's not what we're saying. But we're saying having a buffered asset, buffered as in not correlated with the market, can be beneficial, because that's when we would take money out when the markets are down. When the market's up, okay, let's take our income from the variable bucket. But when the markets are down, maybe we take it from the liquid bucket, because that bucket's not down. Okay. So that's a simplistic example. Let's go through a real life example or simulated example based on returns that we've seen using the S&P 500 in this example. So if we take a 20-year study period, we're going to use a 1% investment fee on this portfolio. I don't know what taxes are going to look like. Let's just say they're 28%. We're using that same $2 million portfolio. Let's just say this person chose to go 75-25, meaning 75% in stocks, 25% in bond. Again, they're taking 80 grand out. Now we're going to take inflation, right? Because I think everyone wants the same 80 grand lifestyle every year. So we're going to use a 3% inflation number. We have no idea if 3% is the right number. We're just using that as a basis because that's what everyone uses. By the way, I'm not saying that you should be using 3%. We're just going stereotype here.
It's just an example.
So here's how this plays out. If you invested like this in the year 2000, here's what you might have seen. If you recall the year 2000, it wasn't great, right? With a 75-25 portfolio, S&P 500 type mix, negative 3% in year one, negative 6.5 in year two, and negative almost 11 in year three. They're taking out 80 grand a year with inflation. Okay. And so when we look at this aspect and taxes taken into consideration, in 20 years, so by the year 2019, this person is down to 240, I'll round up, $243,000.
They're not happy. They're totally freaking out because at this point they're pulling $140,000 a year. They got a year and a half left.
Yeah, so in reality, they probably stopped taking as much income. Like the way this really plays out in real life is, I'm guessing maybe even as soon as 2003, maybe they didn't take out 87 grand. Maybe they took out 67. And I'm making up numbers here, right? Because they're now
Something less.
concerned for something less than the 87 that they were planning to take out based on inflation. So now let's play the true liquidity game, where Alex and I would say, let's do this. Let's take 1.5 and leave it in that same variable bucket. We'll choose the same portfolio for now, which we're going to change it here shortly, but same for now. Same 80 grand, same inflation, same taxes. We're going to use 500,000 in the liquid bucket. We're going to get 4% return in that liquid bucket. And let's just say we've also got life insurance in place as well. So we've got 500,000 in life insurance. So if we play this out, we're doing the scenarios. Again, scenario one, they're left with 242. In scenario two, they're pulling money when the market's down, like in year one. They're not pulling money from the variable bucket. They're pulling it from the true liquidity bucket. And so as you can see, their 500,000, right, is down. And so as we play this out over time, it's a pretty drastic difference. Every year the market's down, they're taking it from true liquidity bucket. Every year the market's up, they take it from the variable bucket. In the year 2019, if we're using that strategy, they still have $1 million.
So they're still down from where they started. They started at 2, they're down to $1 million, but they're at 4 times the amount of money that they would have had in the other strategy. So this is someone who was able to live the lifestyle that they wanted to live for a much longer time period and have less negative impact to where they're at from a lifestyle standpoint, what they're able to create from a cash flow standpoint. They're going to be a lot more safe and secure in what they've done. Oh, and by the way, we took a quarter of the money, $500,000, and made it so that there's extremely low risk with it.
Again, during this 20-year period of time, 16 down years. I'm sorry, 6 down years over this 20-year period of time. And again, that's 6 different times that we would pull money from the true liquid bucket rather than the variable bucket if we use strategy in this. Now, we still actually did not do a apples to apples comparison. Because really, if scenario one, the person was comfortable with a 75-25 portfolio, really we should make this portfolio over here 100% equity because we took $500,000 out. So I'm just curious how this would play out, Alex. We're doing this live. So still better. 242, 748.
Significantly better than where we would have been. And we're looking at a scenario where the downside occurred. We went through two of the worst time periods in the market, the dot-com collapse, the 9/11 issue, and the accounting scandal, all back to back to back years, and then the 2008 collapse. So this was one of the worst times to potentially retire, was the year 2000. Now let's
Yep.
go look at maybe a couple other years that might be better.
So let's go to the 90s. Let's start it at 1990 instead. So if we go to 1990 instead and we do a comparison, if we're doing the variable only bucket, if we're just pulling money out of just variable only, at the end of 20 years, we're at 1.4 million.
It's not bad. We're doing okay there.
If we're still doing that true liquidity strategy, where we've got multiple buckets to pull money from, or we're pulling money from the true liquid bucket in down years, well, we're at 1.9, almost 2 million.
And so the reason why we want to show you these types of things is to go ahead and try to have the conversation around, like, okay, what was the cost of having money in the true liquidity? So in this scenario where we've got mixed markets, the 90s were great for the market, the 2000s were not great for the market, we still wound up in a better situation.
Yeah. So what Alex is alluding to is like common objections that we hear is, well, the money's sitting in the true liquidity bucket's not earning enough. Shouldn't everything be invested? This feels inefficient. And we like to reframe it and say, okay, well, efficient portfolios don't always create successful retirements. Because correct us if we're wrong, and we're open to being wrong, but correct us if we're wrong. You saved all this money to turn on an income stream. So what you care about is the income that's coming from these assets. And if you cared about legacy, we're still showing you a higher legacy in the end as well.
You're going to wind up being able to maintain that lifestyle for a longer period of time under these scenarios. Now, let's go look at, let's cherry pick the ideal situation and look at 1980, Ryan.
Sure. So we're in 1980.
Now, one of the things that we need to make sure that we do is have a conversation around interest rates. We didn't change the interest rate when we moved from the 2000s to the 90s. Maybe we should have. Interest rates were higher in the 90s than they were in the 2000s, but they were very significantly higher in the 80s and still higher in the 90s. So like we were having
Double-digit
interest rates. We had mortgages that were in the 20% range or more. Like I know that like some of the folks that I know that bought their first house back in those days were saying like, oh yeah, we were happy to get a 19% interest rate on our mortgage. And like, just sit with that for a split second of being excited and happy to have a 19% mortgage. So ultimately we were seeing bank accounts get double digit rates of return in the 80s. This calculator won't allow us to give double digit rates of return. So Ryan, let's just use what it'll allow us to give, which is 8%.
So again, we're going to the 80s. Let's take a look at the 80s and how the market did. As you can see, it starts out great. 21% rate of return, 1% positive, 14.5, 20. There's no negatives until 1990 and -8. So in theory, you would think scenario one would crush our strategies that we're looking at. And it did well. You're $2 million. You grew it to 7 million. In 20 years, in 1999, it's worth 7 million. our strategy over here, okay, it got beat. It got beat by $200,000, and that's at 6.8 million.
So the question is, are you willing to trade $200,000 in an up market, the best possible scenario for the markets, or one of the best possible scenarios for the markets, to make sure that you've got 2 or 3 times the amount of money in a down market and are up in a mixed market? So if we take a look at that, like when we show this to clients, virtually every client is like, oh, well, like I care about the worst case scenario because that's what I'm worried about. Like if I wind up with 6.8 versus 7, darn, like I still have $6.8 million. I'm pretty darn happy at that point, right? We like, yeah. Um, I'm pretty sure that that's what you're hiring us to do, is to make sure that we're taking risk off the table and giving you virtually the same rate of return. Um, that's a win in our books. We're trying to go ahead and create these types of strategies where if the market goes bonkers, we're participating in it, and we have taken some of the amount of risk off the table to go ahead and create some of these benefits in
Yeah.
non-ideal markets.
The fact of the matter is, if Alex and I could predict the first 3 years of anyone's retirement, I'm not sure we'd share that information, frankly. So like, I might own my own island, right? So the fact of the matter is no one can predict this, right? And when people are getting into retirement, they're so worried about running out of money. So we want to make sure we're providing them adequate cash flow while still making sure they've got plenty of assets where they don't feel like, bring the emotional aspect into this. They don't feel as though they need to start taking less money. We
Well, and
want them to take more money.
100%. And this is done in the backdrop of it being February 9th, a day after the Seahawks won the Super Bowl. Sorry, Ryan. But yeah, I mean, it's something where we're seeing a lot of volatility out there in the marketplace. There's a lot of headlines that are talking about like, oh, or like how many times have we seen the recession is here, the recession is here, the recession is here? Maybe it is, maybe it isn't. The markets are still positive for the year, despite the last, having lost 6 out of the last 10 days. In terms of the days or 6 out of the last 8 that the market's been open. And so ultimately it's something where in times of uncertainty, that is when this type of planning is the most impactful. And so we need to make sure that we're sharing this message, and having these types of conversations, ideally ahead of times when we see the markets going down. And ultimately, we still have time to be able to implement strategies like this with most of our clients because the markets are still up year to date.
Well,
So,
and the last thing that we'll kind of end on here is a lot of people hear this conversation like, okay, when do I develop the true liquidity bucket? And our comment is always, you should always have the true liquidity bucket, because it's not only flexibility, you're setting yourself up for retirement, it's also flexibility for pre-retirement. As we've always said, or the joke that I always say is, life isn't lived on a spreadsheet, right? Your career shifts, maybe you leave, you get fired, you get laid off. Maybe there's a opportunity that lands in your lap, right? There's different life events that occur pre-retirement where you may want an extra bucket of money that's not correlated with the market, like especially with tech professionals,
mhm.
right? They're awfully nervous right now, and we're working with a lot of them. They're nervous about layoffs right now. And so when we look at their balance sheet, they've got a little bit of cash, but if it took them longer to find a job and they're having to tap other money outside of their cash, they're tapping investments. And if the market's down, that's not a great sign. So having this true liquidity bucket is not just for retirement.
Well, and for a lot of these tech professionals, a lot of their net worth, a lot of their income is in the form of equity positions in their company. And so if you wind up being laid off from your company, chances are you might wind up like that company's stock might also be down at that same
Down.
time.
Yep.
And so like we need to be proactive in terms of trying to protect ourselves. That doesn't mean that we're going to mass sell. It doesn't mean that, like, there are different strategies for how do we go about protecting ourselves in these types of situations. And the other thing that while we say, yes, we should have the true liquidity bucket now, it's also not something that we should just flip a switch and change it overnight. Like, there are tax ramifications to doing things like that. We also, 9 times out of 10, like, we wind up doing things over time. We build that bucket just like you built your retirement nest egg. And so it's something where the vast majority of the time, this doesn't happen overnight. Um, there are certain inflection points and times when, like, we can do it in a more tax favorable nature, but this is where planning comes into play.
Yep.
And everyone's situation is different and unique. So just make sure that you're working with a professional who can take a look at all of the different aspects and help coordinate a plan between your professionals.
So I'll kind of end on this. Your balance sheet isn't purely, or shouldn't, I should say, be purely based on performance. It's more about control, and especially when life and markets don't want to cooperate with that. So we hope this episode is valuable. In the show links, you'll have the link to our YouTube page, as well as if you wanted to get a financial scorecard. Again, this is a scorecard that you can go get. Alex and I do not see the information you put into it. It asks you some questions about your financial situation at a high level, and then it spits out a scorecard for you. And it gives you kind of a red, yellow, green type of card, where red is kind of like, hey, it's a warning. Yellow is kind of like, hey, you might want to look at this. And green is like, hey, you're doing a good job. So if you want to get your own scorecard, check out the show notes there. There's a link for you to do that. And then last but not least, head over to our website, builtforlifenotjustwealth.com. And that's a spot for you to either reach out to us for questions, or if you wanted to have a personal conversation with us, that's also a great spot to reach out to see if it makes sense for us to work together. We hope this episode is valuable for you. And Mr. Collins,
Go Hawks.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
8767734.1 expiration date February 2028.